How central banks work. The institution secretly running your life. Right now, there's an institution you've probably never visited, never voted for directly, and maybe never even thought about. And yet, it has more influence over your rent, your loan, your savings, and even whether you'll have a job next year than almost anyone else on the planet. It can make your mortgage cheaper overnight, or quietly make everything in your life more expensive. And most people have absolutely no idea how it works. So give me the next 10 minutes and I'll explain the central bank in the simplest way possible. The institution that's secretly running your life. We'll start with what a central bank actually is, then look at why it even exists, how its most powerful tool, the interest rate, reaches all the way into your wallet, how it fights inflation, why it's kept independent from politicians, and most importantly, what all of this means for you as a regular person trying to save and invest. Welcome to Finance, where we explain investing concepts in a simple way. But first, a quick disclaimer. This is not financial advice.
So what is a central bank, actually? Let me give you an analogy first. Imagine a huge water reservoir that supplies an entire city. If there's too little water flowing, gardens dry up, businesses can't operate, the city slows down. If there's too much water, you get floods and damage everywhere. So someone needs to sit at the control gate and decide how much water flows into the city, opening it when things are too dry, closing it when there's too much. That person at the control gate for the economy is the central bank. Except instead of water, they're controlling money. A central bank is the institution responsible for managing a country's money and its financial system. You've probably heard of some of them. In the United States, it's the Federal Reserve, or the Fed. In Europe, it's the European Central Bank. In the United Kingdom, it's the Bank of England. Almost every country has one. Now here's something most beginners miss. A central bank is not the same as your regular bank. The bank where you keep your savings, take out a loan, or pay your bills, that's a commercial bank. The central bank doesn't deal with you directly at all. Instead, think of it as the bank of the banks. It's the institution that the commercial banks themselves answer to. So you and I never walk into the central bank, but everything it does flows downhill and eventually lands right on us.
Now let's talk about why this institution even exists in the first place. A central bank really has one main job above all others, keeping prices stable. In plain language, that means keeping inflation under control. Remember, inflation is when prices keep rising over time and your money slowly buys less. A little bit of inflation is normal and even healthy. Too much and your savings get eaten alive. Too little, or worse, falling prices, and the whole economy can freeze up. So the central bank's #1 mission is to keep that water level just right. On top of that, it also works to keep the financial system stable and to support steady, sustainable growth and employment. But price stability is the heart of it. Okay, so it controls the flow of money. But how? This is where it gets interesting. Now let's talk about its most famous tool, the interest rate. The central bank sets something called the policy interest rate. Think of this rate as the master dial for the price of money in the entire country. When the central bank turns that dial, the cost of borrowing money changes for everyone. And here's the part that matters to you. That change flows directly down into your life. Let me show you how. Imagine the policy rate goes up. The central bank is basically making it more expensive for commercial banks to get money. And what do commercial banks do? They pass that cost straight on to you. So your mortgage gets more expensive. Your car loan gets more expensive. Your credit card interest creeps up. New loans become pricier. And when borrowing costs more, people naturally borrow less, spend less, and businesses invest less. The economy cools down. That's the central bank closing the Watergate a little. So why would they ever want to slow the economy down? Wouldn't cheap money and fast growth be good all the time? Here's the catch. If money stays too cheap for too long, people borrow and spend like crazy. Demand explodes faster than the economy can produce, and prices shoot up. That's inflation. So when inflation gets too hot, the central bank raises rates on purpose. It deliberately makes life a bit more expensive in the short term to slow spending and bring prices back under control. It's like a doctor giving you bitter medicine. It's not fun in the moment, but it's meant to keep the whole system healthy.
Let me make this concrete with simple numbers. Say you want to take a $100,000 home loan. If the interest rate is 3%, you're paying roughly $3,000 a year just in interest. Now, the central bank raises rates and your loan rate jumps to 6%. Suddenly, that same loan costs you around $6,000 a year in interest. Nothing about the house changed, you're just paying double, purely because one institution turned a dial. That right there is how a decision made in a meeting room reaches all the way into your monthly budget.
Now here's where it gets even bigger, because interest rates don't just affect loans. Now let's talk about how they move your investments too. Interest rates are one of the biggest drivers of stock prices, bond prices, and real estate. When rates are low, something interesting happens. Safe places to park money, like bonds, pay you very little. So investors go hunting for better returns, and they pour money into stocks and real estate instead. That extra demand pushes prices up. This is partly why, during the low-rate years of around 2020 to 2022, stock and property prices climbed so aggressively. But when rates rise, the whole thing flips. Suddenly, bonds look attractive again because they pay a higher, safer yield. Why take a big risk on stocks when a safe bond pays you well? At the same time, companies face higher borrowing costs, which can shrink their future profits. So money tends to flow out of stocks and real estate, and prices can come under pressure. This is why investors all over the world hang on every single word a central bank says. One sentence about future rates can move trillions.
And this leads to the single most important idea I want you to take away. The central bank doesn't control your life by giving you orders, it controls it by changing the price of money. Everything else, your loan, your rent, your job market, the value of your investments, bends around that one number.
Now, let's talk about something that confuses a lot of people. Why is the central bank kept independent from the government? Central bank independence means the people running it can make decisions without political pressure from politicians. And here's why that matters. Imagine an election is coming up. Politicians love a booming economy and cheap loans right before people vote. It makes everyone feel rich and happy. So there's always a temptation to keep rates super low and spending high, even when that's exactly what causes painful inflation a year or two later. An independent central bank can resist that temptation. It can make the unpopular but necessary choice, like raising rates to fight inflation, even when no politician wants to hear it. That's why independent central banks are generally seen as more credible. People trust that they're focused on long-term stability, not on winning the next election. Now, independence doesn't mean they operate in total isolation. They still coordinate with the government, but the decision on rates stays in their hands, not the politicians.
Let me make all of this real with two characters. Meet Sarah Saver and Lucas Loan. Sarah Saver keeps most of her money sitting in a savings account, and she's terrified of investing. She feels safe. But the central bank holds rates low for years to support the economy, while inflation quietly runs at 4% a year. Her bank pays her barely 1%. So even though the number in her account slowly grows, the real value of her money is shrinking every single year. Sarah didn't do anything wrong, and yet the central bank's decisions quietly cost her purchasing power while she wasn't watching. Now meet Lucas Loan. Lucas took out a large variable rate loan when money was cheap, assuming low rates would last forever. Then inflation spikes, and the central bank raises rates aggressively to cool it down. Lucas's monthly payment jumps, and suddenly his budget is in serious trouble. Same loan, same Lucas, but the cost of his life changed because of decisions made far away. The lesson? Neither of them understood the dial. And when you don't understand the dial, you're at its mercy. When you do understand it, you can actually plan around it.
So, in conclusion, here's the honest truth. You can't control what the central bank does, but you absolutely can understand it, and that changes everything. When you hear that rates are rising, you now know loans will get pricier and stocks might wobble. When you hear rates are falling, you know borrowing gets cheaper and risk assets often get a boost. And you know that holding too much cash during high inflation slowly bleeds your purchasing power, while understanding the cycle helps you make calmer, smarter decisions. The central bank isn't some evil villain pulling strings in the dark. It's more like that person at the Watergate, trying, imperfectly, to keep the whole city from flooding or drying out. The difference between people who feel helpless about the economy and people who feel in control usually isn't money, it's understanding. And now you understand the institution that's quietly shaping your loans, your savings, and your investments.
That's everything I wanted to make clear about central banks. If this helped the economic news finally make a little more sense, I'd really appreciate it if you hit that like button and subscribed to keep growing this community. And if you want to go deeper, I've got a dedicated video on inflation and interest rates that pairs perfectly with this one. You'll probably like that one too. Thanks for watching, and I'll see you very soon.